I'm pleased to discuss Biocon's Q2 FY25 earnings. Let me start by stating that Biocon's consolidated operating revenue of rupees 3,590 crores reflects a year-on-year growth of 8% on a like-for-like basis. Core EBITDA and EBITDA margins of 28% and 20% respectively remained healthy. We had a robust performance in the biosimilars business, up 19% on a like-for-like basis, driven by strong market share gains in our US Oncology and Insulin franchises. Syngene, I'm delighted to say, has returned to sequential growth and has good visibility of a pickup in momentum in the coming quarters, led by both discovery services and biomanufacturing contract manufacturing business. Generics was the one business segment that faced both pricing and demand pressures, and this led to suppressed performance this quarter. But key new formulation launches in Q3 and Q4, especially with respect to GLP-1 liraglutide, provides the basis of a turnaround before the year end. Now, moving to a comprehensive overview of our financial and business segment performance, let me start by saying that at a group level, total revenue was at 3,623 crores, which was a flat performance year on year. However, total revenue grew 7% year on year on an adjusted like-for-like basis, which, let me explain, excludes revenues from the divested branded formulations India business, which was reflected in FY24, as well as the gain from restating the Bicara value in Q2 FY24. Revenue from operations was 3,590 crores, up 8% year on year on an adjusted basis, and more importantly, 5% growth sequentially. Group core EBITDA for the quarter stood at 992 crores, representing a core operating margin of 28%. Quarterly R&D investments stood at rupees 200 crores, corresponding to 7% of revenues ex-Syngene. Reported EBITDA for the quarter stood at 718 crores with a margin of 20%. Profit before tax and exceptional items stood at 72 crores, but at a reported level, we had a net loss for the quarter at 16 crores, which was largely on account of higher tax based on geographical split of profits and, of course, minority interest. And adjusting for exceptional items, the loss stands at 13 crores. Now, coming to key business highlights. Let me start with biosimilars, which are reflected in the Biocon Biologics numbers. Biosimilar revenue was 2,182 crores, up 11% on a reported basis, but 19% on a like-for-like basis, adjusting for revenue in Q2 FY24 from branded formulations India business, which no longer is reflected in our overall business. This growth translated to a core EBITDA of rupees 691 crores, which grew 5% year on year with a margin of 32%. Reported EBITDA was at 469 crores, which grew 4% with a margin of 21%. Now, adjusting for the forex impact of the appreciation of the Japanese yen versus the USD, EBITDA was at 550 crores with a margin of 25%, reflecting the strong underlying profitability of the core business. We continue to invest in our pipeline with R&D investments at 6% of revenue to drive mid and long-term growth. However, I must, add that this level of 6% is perhaps an anomaly this quarter, which is likely to increase in the coming quarters. Now, coming to business performance, the performance of the biosimilars business this quarter was driven by strong market share gains in our US Oncology and Insulins franchises, expansion in Europe, and the extension of the depth and breadth of our patient reach in emerging markets. In the US, we continue to deliver a strong performance across our product portfolio. Our oncology franchise comprising Ogivri, that is biosimilar trastuzumab, and Fulphila, which is biosimilar pegfilgrastim, witnessed robust demand and reported a marked year-on-year market share increase, with Ogivri increasing to 18% from 11% and Fulphila rising to 21% from 15%. Our Semglee and insulin glargine franchise shares continue to be in mid to high teens, including closed-door pharmacy networks and government business. In Europe, market shares have remained largely stable at a regional level, with Germany and France continuing to drive value. Strong growth across key markets and products has allowed us to expand patient access. Hulio, which is our biosimilar adalimumab, maintains its market-leading position in Germany with an 18% share and 11% in France. The company has also made significant strides in expanding its footprint with double-digit growth in the UK and the Mediterranean cluster, which includes UK, Italy, and Spain, as well as partner-led markets. We are also seeing positive traction in JANS as promotion and marketing activities transition to our commercial partner in Japan in the quarter. On the emerging markets front, Biocon Biologics continues to expand the depth and breadth of its patient reach and has secured market-leading shares in several major markets. Example, 74% for 74% for trastuzumab and 86% for bevacizumab in South Africa alone. We have also seen very strong demand for our insulin franchise, especially in Mexico, and for adalimumab and etanercept in Saudi Arabia. We have 15 new launches this quarter in the AFMET and LATAM regions, such as bevacizumab and pegfilgrastim in Saudi Arabia. These new launches will be a key driver of growth going forward. We have also seen an uptick in market shares across self-led markets, which are strategic in terms of priority for us. On the regulatory front, EMA has validated our filing for biosimilar denosumab, and we are on track to complete filings in several other markets later this year. We also signed a settlement and license agreement for Yesintek, our biosimilar ustekinumab, with the originator that paves the way for launch in Europe, UK, Canada, and Japan. Now coming to refinancing our long-term acquisition debt. A standout achievement this quarter was Biocon Biologics' very successful refinancing of its long-term debt of $1.1 billion through a combination of an $800 million USD bond listed in the Singapore Stock Exchange and a new $300 million syndicated loan facility. This was the Biocon Group's debut bond issue, and to be 3x oversubscribed speaks to strong investor confidence in our biosimilars growth potential. Notably, it is the first US dollar bond issuance by any biopharmaceutical company in Asia. The highly successful bond issue provides greater financial liquidity and allows us to deploy investments into the business to fuel growth. Now coming to generics. Generics business revenue was at 624 crores, which actually is a decline of 8% year on year. reflecting not only pricing pressure and demand contraction, but the fact that our pipeline has been of products that need to be rejuvenated with new products. And therefore, revenues this quarter were further impacted by also a planned shutdown of one of our API facilities. However, we maintained investments in R&D to support the strategic investments that we are making in peptides and other complex products across API and formulations. We received a few drug product approvals in the US, UK, EU, and other markets, which will support our near-term sales. We also continued our preparations to address the global GLP-1 market opportunity and are pleased to have signed licensing agreements with two leading pharmaceutical companies in the Middle East and Brazil, respectively, for the commercialization of our GLP-1 products in these regions. Now, coming to research services, Syngene has returned to sequential growth with revenue growing 13% quarter on quarter to 891 crores. We are witnessing early positive signs of recovery in discovery services, largely driven by collaboration with large and mid-sized biopharma clients who are looking for alternatives to China. Delivery of both the early stage projects and the pilot projects has been strong, which provides Syngene with a solid foundation for future growth. We continue to add capacity and capabilities in discovery services at our Bengaluru and Hyderabad campuses in new areas such as antibody drug conjugates, peptides, and oligonucleotides. Development and manufacturing services revenue was led by sustained delivery in biologics manufacturing and an increase in process development projects in small molecules as compared to last year. The repurposing of the biologics manufacturing facility acquired in December last year remains on track to commence operations in the second half of FY25. So our outlook for our business is that we maintain our outlook for a transition to accelerating growth in the second half of the year, with Syngene returning to growth, building momentum in our biosimilars business, and a recovery in generics in the latter part of the second half, driven by the launch of our first GLP-1 generic in the UK, liraglutide. The generics business has been strategically investing in GLP-1 related API and formulation capabilities and capacities over the past 5 years. Market data indicates that the market opportunity for GLP-1s to reach nearly $100 billion by 2028. And we have a comprehensive pipeline to address and compete in this major market opportunity going forward. We are now poised to begin commercialization as innovator GLP-1 medicines start to lose their IP exclusivity with the much-awaited launch of our generic liraglutide in the UK. We are also looking to launch our injectable products such as micafungin and daptomycin in the second half of this fiscal. These formulation launches in Q3 and Q4, we believe, will provide the basis of a turnaround in the generics business before the year end. Biocon Biologics continues to consolidate and leverage its vertically integrated model and global footprint to drive value for the organization. We are doing the groundwork to pave the way for several new launches in the US in the near term. These new launches, coupled with product introductions in other geographies, will serve as key growth catalysts for both revenue and margins. And as for Syngene, we are pleased with the early positive signs of recovery in discovery services, largely driven by collaborations on pilot projects with large and mid-sized biopharma clients looking for alternatives to China to rebalance their supply chains. We are also encouraged to see healthy interest from clients in biologics manufacturing, We have proven capabilities in biologics and additional manufacturing capacity coming online in the second half of the year bodes well for this business. With a strong third quarter already underway, we expect to see a positive change in revenue trajectory in the third quarter, and we remain on track to deliver within our guidance range for the full year. Thank you.